Okay, so we're still on our journey to 1000K. We're still trading, we're still placing trades. We're not in a hurry, we're just looking for quality entry points and then placing our trades accordingly. Also, practicing proper risk management. On this one, our account is now on around 160, so we wanna grow it to 1000K. So let's look at this. We placed a trade on the QML again. I like QML. Yeah, it's got higher chances of giving us profit. So I use it more. Okay, so this one is a long trade. I held for a longer time here. I think it should be around about 20 minutes or so, but it was profitable still. So at times you gotta hold, at times you gotta be patient. Maybe your trade will be in loss. Hopefully it won't be a significant loss because it can mess with your emotions at times. You just feel like coming out of the trade and closing your trades, but that's why we put a stop loss where you calculate your risk and also you calculate how much you are willing to lose so that you don't lose much. If the stop loss stops you out, it's okay. So you can see I'm adding more trades because I'm convinced that this will go down. I'm convinced that this trade will work out. So I just added more positions there. Okay, so I'm waiting for a part where it shows that it's a QML, where you get to see the higher low, the higher high. Then you place your trades in line with the previous higher low. You can go hard if you want, but well, so that you don't lose your account just in case the market goes against you, because at times it might be looking like it's a QML structure, but then the market decides otherwise. Let's say you're in for a sell, the bulls are more powerful than the bears. You'll find out that the price will go up instead of coming down. So it just depends with the market. But normally with this structure, as you can see, the higher low, the higher high, then the trade is placed in line with the previous higher low. Yeah, so that we make profits from there. So ideally, you need to close on the previous higher low from where you placed your trades. You see the higher high, and then it goes down to make a higher low. That's where you have to plan your exit. But at times I don't wait for that. I close. So I can take some profits with me, because at times if you wait for that, excuse my voice, at times if you wait for that, the price can retrace and take in your profits and leaving you with a loss. So you don't want that. So at times it's best if you get a trade like this, you make profits, you can close some, then leave some running, so that you see, when I'm drawing that trend line, it's the trade that's messing with me. Now I'm wondering whether this thing is going to go down or it's not. No one wants a loss, but at times this happens. So you see, I removed it because I just wanted to see if I'm still in the right. So it messes with your emotions at times, but you don't have to go with that. You just need to hold. I don't have much of a loss as yet. Yeah, so as I was saying, you need to check your profits as a previous higher low. Yeah, from the higher high, we go to the higher low, the lowest part reached when the price went down. That's where you have to plan for your exit when it reaches that part. that's more like a support level as well. But at times it has a tendency of even passing that point, so it depends with you. I normally close it, and then I normally close some trades and leave some running with a stop loss, but at times I then close with a loss of the trades that I would have left running, or at times break even. Yeah, because you can also trail with your stop loss. Did you see that QML structure? It's beautiful. This trade, you just know it's going to go down. You just know that you're going to get some profit there. So it will spike. It will spike and actually go down. But with the market at times, you can be certain that your analysis is right, but then the market decides to take you out. Because when you're looking at a market structure, you look at price action. Price action is determined by the big guys, the big guns with the big monies. So we have bears and we have bulls. The bears sell the market, the bulls buy the market. So market movement is determined by the price, where it's either we have a higher demand where we will buy the market, or we have a higher supply zone or a higher supply where we will sell the market. So what determines whether the demand is strong or the supply is stronger? It's the bears and the bulls. So when you see a market structure forming, you'll notice that there's a reason why it does that. Normally it does that when you'll see that when it's a support zone, you have bears, you have the bulls wanting to check that out. There's a spike there. We don't close as yet. We just look at it and see. So we're on a support structure. We have the bulls overriding the bears, so they are more powerful and they push the price up. So that's where you get to see that the price is moving up. But then when we get to a resistance, which is a supply zone, there, if the resistance is strong, if the supply zone is strong, the bears fight back and they actually push the market down. So that's how candlesticks are formed, and that's how market structures are formed. So for you to be profitable and for you to know how to analyze the market, you have to search out the zones. You have to map them out. Even before you start trading, map out your supply zones, map out your demand zones. I normally sell Crash 500. It's the one that I really love trading more than other trades. So after mapping out and marking out your supply zones and your demand zones, you see this easily, because you see that there's a 10 in the market whenever the price reaches that point. Let's say a price reaches a supply zone, which is a resistance zone, you'll see that the price reverses. It reverses from the buying to the selling. So you see that the candlesticks that were going up, they start going down. So at times there might be an accumulation period. At times they might go up, go down, go up, go down, and form a part where the market is just accumulating. It's trying to see whether the supply zone is more powerful, and it's deciding whether it will continue up, break the zone and continue up, or whether it will go down. So after mapping up your zones, you then look for entry points. Your entry points will also be determined by the patterns, the chart patterns, like for this instance, the QML, where you see the higher low, the higher high, and the higher low, and then you place your trade in line with the previous higher low, the one that's nearer the head. So you have to watch out for other things like the maximum pain level. At times the price might go up just to confuse you a bit, because that's what we call the maximum pain level. Then when that level is reached, the market will then come down. You might have been stopped over, or you might have been frustrated and closed your trade. But then you see again the market going down. At this juncture, if there's an entry point, you can still enter the market. right? But if you can't place your trade, you'd rather just wait and learn from it. Because at times you might want to enter the market at this juncture as well, but then it stops you out again, becomes frustrating. So it just depends. You'll just have to see whether you can still enter the market, or you'll have to wait for another chart pattern as well to map out, because these chart patterns repeat themselves. So some of them, you use them for learning. You can even back test and go way back and see how the market moves and see the patterns that are formed, because there are many patterns that the market forms even as it moves. There are double bottoms, there are double tops, QMLs, which is my favorite, because this one, normally you're guaranteed of profit. Like, look at that H1 candlestick pattern there. It's so strongly bullish, convinces you to stay away. But because at times that it's playing with your mind, because that at that level, there's gotta be a reversal, because a QML is a reversal pattern. When price has been going in a certain direction for some time, the QML can map out so that it brings about a reversal. So you can see that M30 candlestick. You'll have to be checking H1, H4, H1, M30, M15, M5, M1, especially M15, M30, and H1 as well. You'll have to be checking the candlesticks as well, so you're not lost. So the QML reverses the previous trends. So trends are important when trading. You'll have to see whether your trend is uptrending or is downtrending, or it's a choppy market, or it's a sideways ranging market. So you'll have to know how to trade each accordingly. Yeah. But when there's a structure like this, when there's a pattern like this, the QML, it's much easier to trade, because it's a reversal pattern. You know that a reversal is imminent. You know that, the pattern, the structure, the market structure, the price action will start going down if it had been going up for a long time, or it will start going up if it had been going down for a long time. Look at that structure. Look at that structure. So you place your trades at the same level where I've placed it. That's where your higher low was. That's where your higher low was. So you wait. You'll have to wait patiently, because you can see it keeps coming down and going up, keeps coming down and going up, but you'll have to wait and see what goes on. Look at my loss now on $12, which is still manageable looking at that account. So at times you need to keep paying attention as well to your loss. So as you can see, we could have even made our entries a bit higher, somewhere around there, but at times you don't want to miss it. The FOMO, fear of missing out, it also makes you place earlier trades. You enter the market much earlier than you were supposed to, because you have the FOMO. The FOMO is playing effects on you, your mind. So that's the fear of missing out, because ideally we could have placed it even just a little bit higher where the price is. Yeah, that way you avoid losses, or you can wait for it to play out nicely. Look at it. There's that thing. $32, putting our account on 195. Ooh. Now that's what I call a good trade. Look at it, from 162 to 195. Not bad, hey? Imagine if you'd hold all those trades until it gets to the previous low, the bottom point where the price tends for it to start going up on that doji there, on that pin bar. If you'd hold to that point, because that's where it's set to go, that's where it's supposed to go. Imagine if you'd hold to that point, you'd get a lot of money. You'd get at least around about $100. But since we're growing this account, I'll have to close these trades. At times you can wait a bit, maybe 2 or 3 candlesticks, to see if it will go down further. Yeah, so you don't miss out on a lot. Times if you see that your profits are enough, you can always close some and leave some. See, they're all different. So these are different entry levels. Because you can see all the funds are different, $6, 5, 4, and 3. So the 3 was the first entry, the 4, second, third, going up like that. As you can see, I'm still holding, but at times if you keep holding, the market can reverse and start again at that same point, or totally go against you, and you have a buy going on and you regret. So what's best is closing some, then you leave some hanging and trail with a stop loss, please. You then move your stop loss to your entry level. Yeah, as the market goes down, as the price goes down, you trail, you follow the price bit by bit, and you put your stop loss just behind resistance zones or support zones, just behind those. That's where you put it. Because at times, the market will be playing out nicely like that. See, now I'm closing some trades. Yep, let's take our money, let's close. Yep, let's close. Let's close them. It's good to close, especially the trades that are near on. The trades that have the lesser amount, so that you have top entries. I've closed most of them there. Yeah, we've left only one. See, now it's on 20, and when it fell, it was on 30. So you see that the market keeps retracing. That's why it's advisable as well to close your trades in profits. So yeah, we're gonna wait and see how it plays out. We've left one, so let's see how it plays out. You can add a stop loss there if you want. Yeah, because at times the network as well can go against you. You have problems as well, like external problems that have nothing to do with your trades. Like if you have a network breach, sure. Yeah, and your price starts reversing, going against your analysis, going against your placed trade. Look at that. That was a sniper trade. That was a sniper entry. Look at that. I like trades like that, where you just place them and it just goes boom. Yeah. So at times the network can go against you. Whilst you think you're in the right and nothing can go wrong, the network just switches off. If you don't have a stop loss, you'll cry. You'll cry foul, my friend. Because if the trade goes against you, it means it will eat into your profits. Then, after eating into your profits, it will cause you losses. Yeah, and you do not want that. So as you can see, you can scale your stop loss. I like Deriv these days. It shows you how much you'd be risking on your stop loss. It gives you the amount as well, so that you make an informed decision on where you'd want your stop loss to be. Yeah, so it's always good to protect your funds. It's always good to protect them. It's always good. Even if you put your stop loss there's my stop loss. And my check profit is supposed to be there. Ideally, that's where my check profit is supposed to be. But because we're not the ones moving the markets, the price will decide. It will decide if we're going there or if we're not headed there. You see? So at times the price might even go back up to that same level. Hit your stop loss, then go and head towards the check profit. So you need to take care when trading.